Hello, welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. And we cover key opportunities and risks for investors tied to developments around the world. And we take your live questions from the chat on YouTube, so you can ask us what's on your mind at any time. Now, there's a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations, but we talk generally about what markets and sectors and areas of investing we think are likely to perform well or poorly and why, although we don't provide an outlook for specific stocks. Clearly, things can and do change, so all the thoughts we share are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves. So please keep all that in mind as we go through the show here and all those disclosures. As is the case every week, I am joined by Michelle Gibley, Director of International Research here at Charles Schwab. Hi, Michelle.
Good morning. I'll be watching the chat today.
Yeah, fantastic. So we'll get to all those questions in just a little bit. I've got a few thoughts up front that we can go through, Michelle, and I'll kick things off as I usually do with what I'm watching this week. Well, we've just really started to kick off a third quarter earnings reporting season this week. We've got 41 S&P 500 companies reporting this week. There were 29 last week, 41 this week, and then we get over like 100 next week. So this is really the ramp up. We've got a few standouts this week, though. We've got AI chip names ASML on Wednesday. That's a Netherlands semiconductor capital equipment maker. And TSMC on Thursday, of course, the biggest chip maker in the world. And then on Tuesday, we hear from the big financials. We got Goldman Sachs, Bank of America, and Citigroup after financials were among the top performing sectors in the third quarter. So we'll learn from them whether that performance was justified and what the outlook is for the U.S. We did hear from JP Morgan and Wells Fargo last week. They rallied, those stocks rallied on a pretty upbeat take. So we'll see if we hear more from that from the financials. We also get September CPI released in the UK, the Eurozone, and Canada this week. All of them are expected by economists to come in below 2%. That's the inflation target for their central bank. And some of them for the first time in over 3 years. That, of course, paving the way for further rate cuts. Speaking of which, on Thursday, the European Central Bank, the ECB, will almost certainly reduce its main policy rate with a 25 basis point rate cut. The case for that action has been strengthened significantly since the last meeting in September, with inflation now below the ECB's 2% target for the first time since 2021. Lowering the policy rate really seems, by 25 basis points, seems like an easy decision to make, and probably at every meeting well into 2025 here, with the economy growing below average potential rate here, unemployment rate on the rise, and then you've also got this very weak inflation picture now. All that points to further rate cuts there in the European Central Bank. I note that even just a few weeks ago, the market was not expecting a rate cut on this week on Thursday. So that's really turned around pretty sharply here in terms of the ECB pursuing a more aggressive monetary policy. Also on Thursday, the U.S. retail sales data is due out for September, and that's expected to show subdued growth, especially when adjusted for inflation. So we'll see what the back-to-school season look like, and if that's any precursor to what we can expect to see as we get to the holiday shopping season. And on Friday, we're going to get China's GDP, retail sales, industrial production, and home prices, all likely pointing to the need for more policy support as GDP continues to track below the government's target of 5%. We know China's policymakers have announced a number of stimulus measures in recent weeks. Few details have followed, though, and the full force of any of those actions wouldn't be felt until 2025 anyway, so things continue to be slowing down within China. In fact, we got some more data this morning showing that loan growth within China just continued to fall. Slowest growth in loans really in the whole long history of that data. So still pretty soft. No one willing to take out a mortgage while home prices continue to slump in China. But Michelle, there's a lot going on. What can you update us on the latest out of China with stocks pulling back last week after a 35% one-month rally, as we previewed might be the case about a week ago?
Yeah, there were a lot of hopes going into the weekend. There was a Ministry of Finance meeting. People were hoping for a fiscal stimulus of maybe 2 trillion yuan or maybe even more. And, we really had, a week ago, as you mentioned, the market had fallen because the National Development and Reform Commission meeting disappointed. So we had Ministry of Finance over the weekend. They did promise more spending, but they did not say what size. And the briefing really had limited support for consumption, and both of those are negatives. But there were some positives in the details. There was some help for local governments who've really been struggling, as well as recapitalizing large banks. Now, we really need to see a durable turn in China's economy coming from the fiscal side. And that's both to offset fiscal tightening that's been happening this year and also to stimulate demand. Fiscal spending this year was 1.6 trillion yuan below budget through August, and that's roughly below the same level as last year as well. Now, the government is targeting an acceleration of spending this year, so that's good. But what's unknown is if the moves announced so far will boost consumer demand without directly targeting it via fiscal transfers. Now, I would say there are still positives here. Policymakers appear to have pivoted. They're acting with more urgency than in the past. And it's not enough yet, but there's still potential for some additional fiscal announcements at some budget meetings later this month or early next month, as well as in mid-December. Now, there have been hints at measures to address some structural issues, namely high precautionary savings due to insufficient social safety nets, but this still may be a long ways off.
Yeah, this chart's an interesting one. So you can see how much the stock market's already pulled back. We've had this incredible rally on the idea that China's government was getting it and they were really going to kick in and provide a lot more stimulus. But, what's happened is it's been repeatedly disappointing. As you note this weekend, again, the Ministry of Finance just coming in with an underwhelming amount of follow through on those announcements and just continues to fall. And you can see here the tightening of fiscal policy. So this is the deficit here. So the blue line is where we're tracking to this year in terms of China's deficit spending. They actually wanted the blue line to be further below the green line. The green line was last year, and so we wanted 1 trillion more than last year in terms of their deficit, meaning just spending more than they're taking in because that juices the economy. It's gone the other way. It's actually even tighter than last year and 1.6 trillion yuan away from where it should be, where they wanted it to be. So really a dramatic fail in terms of Chinese policymakers to really stimulate their economy. It's really a challenging backdrop to try and turn around. Investors clearly might have been overly optimistic that the government seemed to be getting the need for more stimulus. Now they need to actually deliver it. So really underwhelming there and disappointing. The Hang Seng Index of Chinese stocks down 75 basis points today, just furthering that slide on just China not following, over-promising and under-delivering stimulus, as we've repeatedly warned on this show, seem to be likely. That doesn't mean they won't eventually begin to turn the economy around. It's just a very slow process, and the property market continues to deteriorate. But speaking of stimulus, let's pivot to Europe for a second. We've got a rate cut on the table this week from the ECB, 25 basis point, taking the deposit rate down to 3.25% with the continued path of, I think, 25 basis point rate cuts, similar to what we're expecting from the Fed every meeting looking out through the middle of next year. But if you take a look at this chart, it's an interesting one. This is the percent probability in the market, futures market, looking at whether the ECB was going to cut in October or not. And so if you go back to July, late summer, the odds looked really high, and then they really, really faded. And you got to September and the ECB meeting in September, and they kind of said, well, things would really need to deteriorate dramatically for us to cut from here. They didn't. We didn't see dramatic deterioration, but we did see a big swing in expectations. So what happened? What was the change of heart? The data has been relatively soft, but there was still likely modest growth across every major economy in the Eurozone in Q3 for the first time in a long time, since Q1 of 2023. But the outlook for inflation has turned down more sharply. So it was more about the outlook for inflation weakening than the economy weakening. You can see this in my chart here, my favorite leading indicator of inflation, which regular viewers of this show have been seeing for years. The 6-month leading indicator of inflation I like to use is here in blue, and is pointing to inflation remaining around 2% in Europe, which, with some risk that it even falls lower than that, suggesting policy rates are still way too high at 3.5%. This is the survey of purchasing managers, the Eurozone composite PMI input price component. So when they're asking purchasing managers at businesses, what are you paying for your inputs? What are you paying for your raw materials? Usually 6 months later, they pass that on to their customers. And so you can see it's just an amazing job in predicting 6 months later where inflation would be. It works in the US, it works in Japan, it works in Australia, it works in Canada, it works in Europe. And you can see it's kind of hanging around that 2% level and maybe even having some risk of breaking below it. The other reason that we think the ECB is likely to continue to cut rates just about every meeting for maybe the next 9 months or so is very tight fiscal policy. Unlike the US, where the budget deficit has soared to 7% of GDP with no end in sight, in Europe, there's an effective debt ceiling in place that's been reintroduced where governments must manage their budgets to a 3% deficit target. Plans presented in recent weeks show the three largest Eurozone economies, that's Germany, France, and Italy, will all be pursuing tighter fiscal policies in 2025 to rein in their budgets. In Germany, the cuts are intended to adhere to their constitutional court's tightening of the German debt brake, which is just basically saying, we're gonna force you to basically a balanced budget. In France, where cuts are required by the EU because they're in excess of that 3% deficit target, they've got a new prime minister there, has announced his intention to cut spending and introduce new taxes, which the new government appears to support, despite the rise in the far right there that was opposed to all these things in the French elections this summer. They seem to be on board. In Italy, the government announced spending cuts to bring down the Italian deficit from 3.8% this year to below 3% of GDP by 2026. So the ECB is probably going to want to compensate for all this fiscal tightening by easing monetary policy early and steadily. So as the governments are spending less, hard to believe, but there's a place in the world where fiscal discipline is being implemented. The offset to that tends to slow economic growth, kind of pulling money out of the economy. They're going to be cutting rates to try and get more credit growth, to try and get more money into the economy and offset that. That's why one of the reasons why the ECB will likely continue to cut rates because of inflation, because of this tighter fiscal policy. So what's it mean for European stocks? I think there's a tug of war here. Tighter fiscal policy, slower economic growth, a little bit of a drag on economic growth is going to mean a drag on earnings growth. It's not going to be dramatic. The economic drag is probably 0.3% of GDP. So it's not huge. It's not like a 1 or 2% drag on GDP. It's fairly small. And the drag on earnings growth is similarly small, but it's still there. So earnings growth may be a little bit slower than it will be otherwise because of fiscal policy, and markets are generally pricing that in. Analysts are only looking for like mid-single-digit earnings growth for Europe as we look out for the next 12 months. At the same time, though, easing monetary policy is generally good for boosting valuations. So tighter fiscal policy weighing on earnings, easier monetary policy pushing up valuations, and that might net out in a favorable way for Europe because again, earnings growth expectations were already pretty lackluster. Mid-single digit earnings growth, but valuations are average in Europe and they offer some potential upside if rates continue to be cut. Last time we saw rates being cut in Europe, we saw PEs did rise back in 2009 and 2011 through 2024. Those were past easing cycles. And during those periods, you can see in this chart here in 2009, the PE went up. Between 2011 and 2014, the PE went up a lot. It went from like 8 to around 13 times earnings. So steady rise generally. Even those were weak earnings environments, but what we saw were valuations rise. So that's what I'm saying here again this time. Maybe we get a soft earnings environment with the analysts already seemingly braced for that and the stocks braced for that. But valuations could climb on this easier monetary policy. So it's a little bit of a mixed bag in terms of slower growth and earnings in the economy, but maybe better valuations, possibly netting out in a more positive way.
Yeah, I'd add on the idea of monetary policy easing. It's not just Europe. We are having a globally synchronized easing cycle, and we have it in the chart. It shows the number of central banks easing continue to grow, and the number of central banks cutting is now outpacing the number hiking. 13 of 18 developed market central banks are cutting. Korea, not a developed market, but they cut rates for the first time this cycle last week. Additionally, central banks are stepping up the pace of cuts. New Zealand joined the Fed by cutting 50 basis points last week, and both New Zealand and Sweden have signaled that they could cut by 50 basis points at a future meeting. Policymakers from both the ECB and the Bank of England recently signaled the possibility of rate cuts at a consecutive meeting. So that's a dovish shift, as you mentioned earlier. Markets were earlier expecting a pause from both central banks. And also, as you noted, headline inflation in the Eurozone fell below the 2% target in September for the first time since 2021. So that really boosts the case for the ECB to cut rate. And, the reason is what we're seeing is more policymakers are gaining confidence that inflation is moderating, and they're viewing the downside economic risks as outpacing the risk of inflation reaccelerating. And so that's really a pivot for the focus of monetary policy. That said, inflation could jump around on a month-to-month basis, and it does have upside risks from geopolitical factors, such as maybe a supply disruption in the Middle East. We still have diversion in shipping lanes as well. And there's a potential for upside risk to food prices in some countries like Brazil and India from bad weather.
Yeah, inflation is a hard thing to predict. The PMI survey does a wonderful job of it, but it really only looks at 6 months, right? It's really hard to tell where inflation is going to be 12 months from now. There's so many factors, as you noted, that can influence it. One of the things I think that's really impacting the market's view of why central banks are going to be committed to cuts is the state of the labor market, right? Expectations about rate cuts, particularly for the Fed, just seem to swing dramatically around, the first Friday of the month when we get that jobs report. They're just obsessed with what the jobs picture is because it's been so resilient. And even the weekly initial jobless claims numbers, which we get every Thursday at 8:30 a.m., the initial claims for unemployment benefits, as if they're the only things that matter to the Fed and other central bankers' outlooks for cuts, is that job market. But I don't think it's really all about jobs. The U.S. labor market has been resilient, but let's put this in perspective. The idea that the U.S. has been the strongest major country from the perspective of U.S. job growth is completely misguided. Growth in the U.S. labor force since the start of 2020 pales in comparison to most G7 peers. So if you look back to just before the pandemic, it's amazing. Most countries have actually outpaced U.S. job growth. More recently, growth in Australia and Canada, which are near the top of this chart, has outpaced U.S. job growth over the past year. So this idea that the U.S. is, the best dirty shirt in the world, growth in the U.S. is defying expectations everywhere else. The U.S. job market so strong, that's the reason. It's actually been stronger elsewhere. Yet, that hasn't been the key to what their central banks have been doing. The Bank of Canada has cut rates 3 times this year, right? That's at the top of this chart, right? Strongest job market up there, or second best job market there since 2020 is Canada. And particularly over the last year, Canada's job growth is up like 2%. Yet the Reserve Bank of Australia has yet to even start to cut rates. That's number 1 on this chart. So it really hasn't been the key to why those central banks have been cutting or not cutting. It really hasn't been about the job market. It's been about their economy. It's been about their inflation picture more so than it's been the job market. So I think the obsession the market has had over job growth as the key to central bank actions has just been really misguided. So if we put that out there, we say we really need to be looking at inflation stuff, which we have. That doesn't mean we want to set aside the jobs picture, because it is important as we relate to consumer spending here and think about what it could mean for the upcoming holiday shopping season, which we know consumer spending drives a lot of the world's growth. So if the job market does start to weaken, it can circle back into economics. So Michelle, looking forward, we know the job picture has actually been pretty good around the world, particularly Australia, Canada, as I mentioned. But what is the outlook for job growth in Europe?
Yeah, I think what's interesting is the comparison of unemployment rates in the U.S. versus the Eurozone. While the U.S. unemployment rate has increased from 3.4% to 4.1%, despite a strong economy, the unemployment rate in the Eurozone has stayed at a historic low of 6.4%, despite signs of weakness in its economy. The difference is the impact of labor laws and unions. In Europe, labor laws reduce the flexibility of employers to lay off workers. So companies hold on to employees even after demand wanes. And we can see this in the chart. It's the ECB's measure of labor hoarding. And we can see it's still above pre-pandemic levels. However, we're seeing some weakness in the manufacturing sector and also fewer job vacancies. So unemployment could tick higher despite still some labor hoarding. More importantly for the ECB, the easing in the labor market could reduce wage growth when the next cycle of union negotiations occurs. And that's really the ECB's expectation. And it could help them to cut rates not only this week, but also at their next meeting in December.
Yeah, you mentioned the softer manufacturing sector, which brings me to the maybe bigger news this week, right? Earnings. So we previewed this a lot. I mean, earnings are going to be a really good check on, what is the state of business, what is the state of the economy, maybe the jobs outlook. Analyst earnings revisions are looking really weak this quarter, which makes me a little bit worried as we move through this earnings season, maybe what we hear about future job prospects and growth prospects. As we approach the rush of earnings next week, analysts have been really downbeat on prospects. Relatively few upward revisions to earnings, but a typical number of downward revisions at this point in the quarter. I've got a chart here that could leave the potential for upside guidance or maybe presage a softer outlook from corporate leaders as we go through the reporting season. So there's maybe a break one way or the other here. The MSCI World Index tracks large cap companies around the world, but 72% of the index is made up of US companies here. So this really is a story about the US as much as it is the rest of the world. You take a look at this chart here, you've got the blue line here. Come up in a
Well,
minute
it looks
here.
like we don't have the chart. Sorry.
Oh gosh, sorry about that. So anyway, if you go to my, if you want to navigate my Twitter feed or on LinkedIn, and I'll just tell you what it says. So essentially, every quarter we go through this process where right about now we hit the biggest number of downward revisions to earnings because we're right before companies actually start to report. They tend to report and beat, right? And then they guide up. So usually right now we've gone through the pre-announcement season where companies that aren't going to hit their numbers are telling analysts this. So usually we go through this pattern every quarter, every 3 months, we see this dive in earnings expectations and then a rebound. So we see a lot of downgrades now, and then we see a lot of upgrades coming. Here's the thing. We have the lowest number of upgrades to earnings estimates that we've seen in any recent quarter. So normally there's still some upgrades happening. Not. So either that suggests companies are absolutely going to kill it this quarter with numbers way ahead of expectations, or there's some softer news ahead and analysts might need to take down their future expectations for earnings growth for companies. And we'll have to see. So it's kind of one way or the other. Companies kill it and they beat, or we're going to see some downward guidance. Again, we're seeing a normal number of downward revisions right now. So we're not seeing a greater number of companies than usual confessing that they're going to miss for the quarter, but just very, very few upbeat takes from business leaders in their communications with analysts. Analysts really taking their numbers down. So again, we'll see what happens this earnings season. I'm guessing maybe it's a little bit of both. Companies beat, but they're a little bit softer in terms of their outlook for next year. And so I'm not sure, that could mean some volatility for stocks as we move through the earnings season because you're going to get companies that are in better position than others. And we'll have to see what that means. It could mean greater risk for some of the high flyers recently, very high valuations on very high earnings growth, because that earnings growth number could come down even if they beat on the current quarter. So we'll have to see what that holds. It's sort of an interesting, something we haven't seen in recent quarters. So I just wanted to highlight it. It's in my Twitter feed. I don't know that it's super critical to investors at the moment. It's more of an individual stock thing as we move through the quarter, but it's just noteworthy. So I'll tell you what, on that note, let's see what's coming in with the Q&A chat there, Heather. I mean, Michelle.
Yeah, I'm stepping in for Heather on the chat today since she's out. There's a question about what your outlook is for crude oil prices, and maybe kind of looping in on that. We had the OPEC demand forecast revised down today. So, what are your expectations there?
Yeah, so just looking over my screen here. So West Texas Intermediate crude down about 2% today to $74. So kind of pulling back a little bit as we thought. 77 maybe the high here lately. About the middle of the range, 65 to $85 range over the past year or so. We jumped up to the middle of that range on concerns about conflict, but demand is really soft. So, this weekend's Ministry of Finance stimulus announcement, as Michelle said, really underwhelmed the markets, notably the outlook for oil demand, with prices falling today on few signs of halting the slide in oil demand from what's the world's biggest consumer, top importer of oil. Global oil consumption is now expected to increase 1.9 million barrels per day this year. It's about 2% in 2024. But that's 106,000 barrels a day less than forecast a month ago. OPEC said in its monthly report today, and that's the third monthly downgrade in a row by OPEC. So we are seeing kind of this weaker economic picture headlined by China result in a weaker oil outlook. So I think we're running into this conflict between a geopolitical driven rise in oil prices, concerned about maybe supply disruptions, running into the reality of a very lackluster demand pulling down prices today. Not surprising. I think oil probably retreats a little bit further over the course of this week. So yeah, that's an interesting one. I mean, it doesn't mean the energy sector can't do okay here. Looking at $75, $70 to $75 oil can still be fairly profitable as we look out for the energy sector, but the momentum behind that move is probably going to fade here over the course of the next week or two.
Yeah, I think maybe what's interesting too is that there's a lot of expectation that China stimulus will mean increased demand for industrial commodities as well. And I'm not so sure that that's going to be the case this time. I really don't think we're going to see a big, hopefully we won't see a big construction of more property in China. Really, there's just so much excess inventory that needs to be worked down. There could be some infrastructure spending. Again, hopefully not, because that's not what they really need more of. They need to be focusing on consumption-led stimulus. So we'll see how that turns out. Another question is on Taiwan. We're seeing some military exercises over the weekend. What's your perspective there?
So my perspective, I think, is the same as the stock market. So Taiwan's TAIEX index this morning up 32 basis points. So Taiwan stocks up even after China's armed forces held drills off of Taiwan that were intended as a warning to halt, separatist acts, as they referred to it. Taiwan's president last week said in a speech that he would work to resist any encroachment upon Taiwan's sovereignty by China. And China responded to that with some military drills. But I think the stock market move illustrates conflict remains unlikely between China and Taiwan for many reasons. I'll give you two. Taiwan's president's party, the historically pro-independence DPP, lost control of the legislature in January's election, which saw the rise in the influence of the pro-China Kuomintang. That's the Chinese reunification party. They have eventual reunification with China in their charter. So China has no reason to invade Taiwan if politics within Taiwan are shifting in favor of China. Taiwan is not moving out of China's orbit, so to speak, pulling more and more away in a separatist movement to actually coming closer together politically. Second, Taiwan's National Chengchi University, you've heard me refer to this many times, they do a survey every 6 months and have for over 20 years of the Taiwanese people on independence versus reunification with China. The latest reading, which was published this summer, has continued to show an overwhelming majority of Taiwanese in favor of the status quo, rather than a shift to either independence or reunification. In fact, sentiment favoring independence has been declining now in recent years. I think this is 3 years in a row, 4 years in a row, that sentiment favoring independence has been on the decline, even as tensions over that have increased. So that further suggests an invasion is unneeded, as Taiwan is not pulling away in some kind of rising separatist movement. Nothing's happening politically or socially within Taiwan that would prompt China to take a very aggressive step in the way of an invasion to stop some kind of separatist movement. Just not happening. And so I would agree with China's stock market movement this morning, suggesting that these are just exercises, part of the status quo, really not some sign that any kind of invasion is imminent.
All right, I don't think I see any more questions at this point. I think we're at time.
All right. Well, thanks so much, Michelle. And thanks everybody for your questions and as always, your participation in the show always makes us better. We'll always try and get to your questions. So thanks to our producers as well, Andrew and Gabe, and everyone for the questions and for joining us. Tune in each week at 11 a.m. Eastern or catch the replay on YouTube. And be sure to click and like the show. Share your comments on what you're watching in the markets. We'll check those out. And I'll see you next week.